24 financial terms you should know. Understanding economic concepts and putting them to use in your daily life requires a working knowledge of common financial terms. Yet the world of finance can be scary if you don't know them. Your ability to make sound financial decisions may also benefit from a thorough understanding of such terms. If you put in the time to learn these concepts, you'll be better equipped to have productive conversations about money with your coworkers, clients, and investors. This video provides the definition of 24 financial terms you should be familiar with. So here are 24 financial terms you should know. Number 1. Asset. An asset can be anything that has economic worth that a person or company possesses. Current assets, also known as liquid assets, are possessions that may be swiftly and readily converted into cash by their owners, sometimes within a year. Checking or savings account balances, inventories, and short-term investments are a few examples. Fixed assets, often known as non-current assets, require more time to liquidate. Property, machinery, and equipment are some examples. Tangible assets are material things like money or equipment. While not tangible items, intangible assets like trademarks, patents, copyrights, and franchise agreements nonetheless have value. Assets are listed on a company's balance sheet. Number 2. Liability. A liability is a debt or sum of money that a person or business owes to another person or business. Liabilities include things like credit card debt, accounts payable, and bank loans. Non-current obligations, such mortgages and leases, have longer payment terms than current liabilities, which are due within a year. Liabilities are listed on a company's balance sheet, just like assets are. Number 3. Loan. An amount of money or an object that one entity, an individual or a firm, enables another entity, an individual or a company, to borrow is known as a loan. The borrower pays back their loan to the lender within a predetermined timeframe, together with any applicable interest and sometimes additional costs. An individual often has to give a rationale for the loan, as well as financial details to the lender, such as their credit score and job documentation. When a lender requests collateral, the borrower and the lender agree that the lender may take possession of the borrower's property as a result of the borrower failing on the loan. Number 4. Interest. Interest is the extra cost incurred by borrowers of borrowed funds. Institutions that provide a loan to an entity frequently charge interest at a rate based on a percentage of the loan. For instance, if a person obtains a $75,000 loan for a car, they could also be required to pay interest of an additional 8% of the loan amount, or $6,000. Other variables, such as a person's credit rating and how long it takes them to repay the money, can also affect interest rates. Additionally, when people save or invest money, they might receive interest. Number 5. Compound interest. Compound interest is the amount of interest gained on a loan or deposit that is calculated based on the principal amount, as well as the interest that has accrued over time. Banks and lenders compute simple interest as a percentage of the loan or deposit's initial or principal amount, but compute compound interest as a percentage of the loan or deposit's annual growth. Compound interest thereby accelerates the growth of a deposit or debt more quickly than simple interest. Number 6. Credit. Credit is a legal arrangement whereby a lender lends money to a borrower on the condition that the borrower will repay the loan at a later date. A borrower can prove their reliability in a number of ways, such as by routinely making full and on-time payments on their credit. The most typical example of paying using credit is using a credit card. Number 7. Investment. An investment is a financial decision made with the hope of generating a profit or other visible gain. When making an investment, people don't intend to use the item they bought. Instead, they hang on to it to increase its worth or their financial situation. Many people put money into the stock market with the intention of making money off of it. Individuals may also buy assets that appreciate in value over a later date. A borrower can prove their reliability in a number of ways, such as by routinely making full and on-time payments on their credit. The most typical example of paying using credit is using a credit card. Number 7. Investment. An investment is a financial decision made with the hope of generating a profit or other visible gain. When making an investment, people don't intend to use the item they bought. Instead, they hang on to it to increase its worth or their financial situation. Many people put money into the stock market with the intention of making money off of it. Individuals may also buy assets that appreciate in value over time, such as real estate. Number 8. Net worth. Net worth is the sum of an individual's or company's assets less the total amount of debts due. The difference between an entity's assets and liabilities is what it stands for. A person's net worth may be calculated by adding up all of their assets and deducting their debt from that sum. Number 9. Income. The money that an entity makes through employment or investments is known as income. For instance, a salesman can make money by offering clients things. While revenue is the entire amount of money a company makes through its regular operations, net income or net profit is the amount of money a company makes after deducting expenditures or expenses. Number 10. Expenses. The costs associated with running a firm and producing income are called expenses. Rental fees, utilities, staff salaries, and marketing charges are typical examples of expenses. Businesses keep account of their expenses for profit and loss statements and can deduct part of these costs from their taxable income, provided that they follow IRS regulations. Number 11. Budget. A budget is a financial strategy created by an organization that specifies how much money will be spent over a specific time period. People and corporations frequently take into account aspects like income, assets, and obligations while developing budgets. The budget can assist organizations in comparing their income and expenses, enabling them to make financial choices or future plans. Number 12. Asset allocation. Asset allocation refers to a company's choice of the assets it intends to invest in. Cash, stocks, and bonds are the three basic asset classifications or asset categories. Organizations often weigh the possible risks and returns while making these investment decisions. Eventually, businesses may rebalance their asset allocation to better suit their demands or boost earnings. Number 13. Stocks. Stocks, also known as equities, are fractions or shares of a company's ownership. Companies sell shares or stocks to obtain funds for product development, debt repayment, and corporate expansion. A person or firm invests in a firm when they purchase its shares. Investors may choose to sell their stocks at a later time for a profit, since their value might rise over time. If the stock offers dividends or shares of the company's earnings, they stand to gain as well. Number 14. Bonds. Bonds are a sort of fixed income security that are investments in debt. By purchasing a bond, a person grants permission for a company or government, frequently to borrow money for a specific time period. The firm pays the investment back in monthly installments, sometimes with interest. Number 15. Capital gains. Capital gains are increases in an asset's worth above the cost at which it was purchased. It stands for the difference in value between an item's purchasing price and its current value. When an entity sells the asset or investment, a realized capital gain happens. When an investment or asset loses value after being purchased, a capital loss occurs. Number 16. Mortgage. A mortgage is a loan used to purchase real estate. People make interest-bearing, recurring payments on their mortgages to banks or other lenders over a predetermined time. The asset is used as collateral, and if the borrower defaults on their payments, the lender may seize it. Number 17. Amortization. Amortization is the practice of paying off debt over a certain length of time in regular installments. based on the total loan amount and the agreed-upon interest rate. Lenders or other organizations compute amortization. The payment, which is typically made each month, consists of both the loan balance and the interest charges. Number 18. Taxes. Taxes are fees that people or businesses pay to the government in order to support public services and government spending. Governments can utilize tax revenue for things like national security, police and fire protection, community improvement, and debt repayment. Number 19. AGI. AGI, or Adjusted Gross Income, is the sum of all earnings and investment income less IRS-approved income adjustments. These modifications could take the form of job expenditures, retirement account payments, or interest on student loans. The AGI of people is used by the IRS to assess their taxable income and whether they are eligible for any tax credits or deductions. Number 20. Accounts receivable. The money that clients or customers owe a firm for goods or services they received is known as accounts receivable. It denotes that a sale has been made, but that the company has not yet been paid for it. Customers are frequently given invoices from businesses that include the amount owing, as well as an asset listing for accounts receivable on balance sheets. Number 21. Accounts payable. The money that a company owes to other firms for goods or services rendered is known as accounts payable. This idea refers to when a company receives a product or service, frequently acquired on credit, but has not yet paid for it. On balance sheets, businesses list accounts payable as short-term liabilities or obligations. Number 22. Balance sheet. One of the essential financial documents produced by a firm is a balance sheet. It shows an organization's assets, liabilities, and shareholders' equity to show its financial situation at a specific period. The two sides of this financial statement, which includes assets on one side and liabilities and shareholders' equity on the other, must be equal. Number 23. Income statement. Another essential financial document for organizations is an income statement, commonly referred to as a profit and loss statement. This document, which is frequently monthly, summarizes a company's revenues, costs, and losses for a specific time period. This financial statement aids in assessing a company's capacity for profit and possibility for expansion. Number 24. Cash flow statement. The third essential financial document for organizations is a cash flow statement. This report shows how much money entered and left a company within a specific time period. A cash flow statement gauges an organization's solvency or its capacity to cover its obligations. The company has positive cash flow if more money comes in than goes out. There are many more financial terms that you should be aware of. These were the most basic ones that everyone should know. For more such informative videos, do subscribe and have a great day.